This content is general in nature and should not be considered financial advice. Please listen to the full disclaimer at the end of our podcast. All right, ladies and gentlemen, welcome back to another episode of our Property and Finance podcast. Today, we have our legal partner as our guest speaker, LAS Lawyers, and one of the principals there, Justin Sammut. Welcome aboard.
Yeah, thank you for having me, Theo. Pleasure to be here.
So, a bit of background about LAS and the team there. So LAS Lawyers have around 40 staff across the country. So they support property transactions in every state.
Yeah, in every state. So we've got our in-house staff that's obviously located in the Sydney CBD, and then we have access to online staff located in each jurisdiction that we operate in. So we've got access to support in Western Australia, South Australia, and Victoria.
Yeah,
and then all of Queensland and New South Wales we just do in-house ourselves.
So
that's fantastic.
Business has been going for almost 40 years, started in the 80s. The original, foundation of the offering was supporting the hospitality group. And all these, so when I say hospitality, mainly like hotel and pub owners, then these hotel and pub owners sort of accrued some wealth and became property developers, which then needed a different skill set from their legal team. So then LAS sort of developed that skill set, and became property solicitors is the core focus. So which was a big sort of attraction for us, because it's more than just regular conveyancing. It's more than just, reviewing a contract. There's even a bit of town planning involved.
Right.
So it's for us as a legal partner to meet the needs and requirements of our ever-growing audience. And what I mean by ever-growing audience, where, as everyone probably knows by now, we've branched more and more into the commercial space. So that commercial space needs a broader range of legal services, which is exactly what LAS Lawyers offers.
Yeah, correct. Yeah, so as you're aware better than anyone, you guys have an extremely diverse client base. You guys really go from your first home buyers, never done a transaction before, never spoken to a solicitor before, to you guys obviously service as well your super high net worth clients that are either buying substantially expensive properties or otherwise, transacting in the commercial space as well. So it's very good for us, and obviously very valuable for you and your team to have a partner aligned with you that can service and accommodate that breadth and width of client as well.
Yeah. So it's great to have you on board. Today, we want to talk about some of the common legal, considerations, hurdles, mistakes, incorrect assumptions that people make in the legal world of transacting on property. There's becoming more and more for people to be aware of when purchasing a property. Some vendors have solicitors that be a bit cute with clauses. So we're today's session is basically making sure that our listeners and our audience are across, those various things to consider along the way in purchasing a property. So let's dive straight into that. Our first topic on the agenda is exactly that: common legal issues or mistakes in today's emerging property market that both buyers and vendors are making. And we've called out sort of 4 key points there that we want to talk about. First one: buyers committing emotionally before understanding the contract.
Okay. Yeah.
So why don't you
that's obviously a point that's more geared obviously towards your purchaser, right? And it's not just exclusive to first home buyers, probably more common in first home buyers, but also common for just anyone that's looking to otherwise purchase a new family home. Right, so it's very easy, whether you're a first home buyer or even if this is your 5th property purchase, and it's to be your principal place of residence. It's very hard to take a step back when you are in love with the property. Right, you and your wife and your kids have maybe been to a couple open homes, seen it. You can picture your kids playing in that backyard or swimming in that swimming pool. Potentially close to the local school that you want to send your kids to, and all of a sudden, once you've seen that product, it's very hard to unsee it.
And then the emotion takes over commercial acumen, common sense, and then traditional practices go out the door.
100%, right? Happens all the time, and more so in the case of a first home buyer, they've been searching for a long time. Property market's very competitive, and sometimes for them it's even just more so frustration. They just want to buy something. So they're emotionally charged and they've missed out at 10 different options and they're just sick of it. And it's very hard to then also get them to step back and say, no, you just need to pick a number that works with your finances, a number that you're otherwise comfortable with and you're not too leveraged or you're not too stretched. And that's your game plan. That's the money you need to offer. And if you miss out, unfortunately, you miss out. There'll always be another apartment. There'll always be another house to consider.
So then elaborate, that's in the negotiating sort of process. What about the vendors assuming standard contracts and are safe and neutral, and the other sort of assumptions that they might make because of the emotions taking over, which can lead to big mistakes?
Yeah, so sometimes something that might be a little bit sneaky is you have a contract that's actually not that big. So it's might only be 20 pages, might only be 30 pages, right? And so yes, I can appreciate anyone thinks that they can otherwise read it or interpret it or understand it, or they've gotten a contract and, it's more prevalent now than ever before. Chuck it into ChatGPT and say, hey, is this contract good? Are there any issues, right? ChatGPT will generate a response. But where a lot of the damage is done is actually
special condition.
Well, it's the special conditions, but people know to read the special conditions. Where a lot of the damage is done is just minor amendments in the special conditions to the standard conditions, right? So because those amendments are only usually a few words, it might be something like, clause whatever 4.5, remove the word reasonable. Just something simple as that. You just look at it and you just very easy for someone that's a layperson to just breeze past that. And now all of a sudden, you've now given a vendor the power to not have to necessarily act reasonably when maybe replying to a requisition, and requisitions are your opportunity to ask particular questions about title. Are they aware of any encroachments on the property? Are they aware of anything that might not be otherwise obvious to someone that's doing general inspection, right? You go to an open house, you go to inspection. What are you there for? 20 minutes, right? You're not going to notice any, all the issues with the house, or if a fence is on the wrong boundary or something like that.
Well, a lot of these issues actually that would be in the contract aren't going to be noticeable issues sometimes at the property.
Correct. That's right. You know what I mean? So hence why, as I said, a lot of the damage is done by way of amending the standard conditions in just very, very simple terms. Could be just simple things like maybe reducing a notice to complete period from 14 days down to 7 days. All of a sudden, you could be pressed up against time to find an additional source of finance. So yeah, there's lots of real gotchas. Buried in the standard conditions.
And what about sort of on the sort of elaborating on the special condition clauses that have somewhat got quite more aggressive in recent years? What are some of those aggressive conditions that you've seen? You sort of touched on them, but
yeah. So historically, we've had such a booming property market, right? A very aggressive property market whereby there's 10 to 20 purchases for every home. And because of that, vendors have been traditionally spoiled, where they can just put in the special conditions, effectively whatever they like, and someone's just going to accept it, right? And probably the most common, most aggressive special condition is the fact that they don't provide any warranty whatsoever with respect to the condition of the property, whether or not any of the services, so, your sewer, your stormwater, electricity, whether any of those even work or if they're connected to it, whether or not any of the appliances work. So, over the last few years, contracts have almost been prepared on a get what you're given basis. Come settlement day, you get what you're given, and so be it, right? Granted, there are, ability to raise a claim if there is a substantial change in the condition of the property since the time of signing and settlement. But generally, if there's something wrong with it, there's something wrong with it, and it's just bad luck, right? What we're finding now, because the property market's slowly starting to change, interest rates have gone up, people are a bit more scared, or their borrowing capacity is a bit tighter. And now
sentiment changed overnight.
Yeah, sentiment changed overnight. You've got always talk of high inflation and unemployment. So the news keeps everyone scared.
Basically as their job.
As their job, right? So now you find some of that sentiment flowing through at a contract level. So now all of a sudden you are finding that solicitors acting for vendors are somewhat a lot more amenable to agreeing to change their special conditions, whereby they will state, hey, we do warrant that the condition of the services will be in working order as that settlement, in order to make sure that they've provided the buyer with enough comfort that they're at least going to be purchasing a working home. Come settlement day.
So I guess moving on from that, another thing that's quite common is the timelines or timeframes that are set as standard conditions in these contracts, which aren't really reasonable.
Yeah, well,
so a big one there's cooling off periods, especially for first home buyers that need to try and get these approvals for the first home buyer scheme that can't get done in the 5-day cooling off.
Well, that's right. So that's also another part of the negotiation that has to be taken into consideration, right? So particularly for first home buyers where they have that extra step of approvals that they otherwise need to get their funding across the line, you need to make sure that you get them effectively a 10-day cooling off period, right? To allow...
Which still can be a stretch.
It still can be a stretch, right?
Yeah.
I know, for instance, there's a couple of banks at the moment that just have a massive influx of these types of applications and, the backlog happens. So it's then also trying to do the dance at the time of negotiating to make sure that when presenting an offer that has a 10-day cooling off period, that's then not too uncompetitive against someone else that doesn't need a 10-day cooling off period. Do we need to offer a little bit of extra cash? Do we have a vendor that's maybe sympathetic and, would like to see a family, get their first property? So they're all things that need to be taken into consideration, but just goes to show how with lending policies and with government policies has changed timelines, and your standard contract is not suited to accommodate those policy changes.
Well, it's funny you say that, and I guess going a little bit off the agenda here, but yes, in a lot of markets, the standard contract is expected to be amended and not applied. So, staying on the topic of cooling off periods, in a lot of hot markets like the eastern suburbs, lower North Shore, Northern Beaches, even in Sydney, there is no cooling off. They sign a 66W to waive the rights of a cooling off period.
Yeah.
And that's the norm.
That's right.
There's a New South Wales standard contract, but the norm is to ignore the cooling off period.
Yeah, 100%, right? So definitely that's something you see in those eastern suburbs in a lot more of those wealthier markets. We're also seeing that now in your market that is sort of catered towards your first home buyers. So, a lot of these new home builds that are happening in the northwest suburbs of Sydney, we're starting to find that agents are just listing properties for auction that ordinarily don't have any business being listed for auction, but they do that on the false pretense of being able to say to purchasers,
unconditional offers only.
This property is going to auction in 2 weeks' time. It's going to sell.
So let's elaborate on that point for our listeners to understand what that even means and why. So if a property is going for auction or going to auction, naturally the vendor doesn't want the property to be taken off market to go into a 5 or 10-day cooling off period to then later be told the purchaser is not going ahead.
Correct.
Because they've done a building and pest and there was,
an issue,
some ants or something in the basement.
Yep.
And then the property is perceived to be taken off the market and put back on the market for the upcoming auction.
Yep.
Then all of a sudden, all the serious bidders or buyers that were willing to make an offer at auction now think there's something stale with the property. There's something off, and they might only have a week before auction to do their own due diligence to figure out what that is. So naturally, waiving the rights to a cooling off period for a property that's going to auction is somewhat reasonable and expected. And that hence why these 66Ws are signed in that instance.
Yep, that's right. So then, knowing that is a common occurrence, right, or to some extent an expectation of vendors, it's then making sure that the purchaser in any scenario just has as much information or access to information as early as possible, How quickly can we get them the contract review and get them advice on the contract? How quickly can we make them aware of any type of risk that might be associated with this particular property purchase? How quickly can you guys get them comfortable with respect to their finance position? Because if we are signing a 66W certificate, that's it. Deal's done on that day. They're locked in. Come 42 days' time, if for some reason maybe a valuation comes up short, bad luck. They need to find the money. So it's just making them aware that that's going to be the position that they're going to be in.
Yeah, and on that note, sometimes it's a different process for the valuer when they're going there to value a property that hasn't been sold versus a property that has been sold.
Correct.
They are going to be conservative, and so you can sometimes cook the process yourself by trying to dot your I's and cross your T's in that cooling off period.
Yep.
Yeah.
Yep. And it happens. Sometimes valuations do come up short, and it can very easily happen in an auction scenario. Like I said, as we touched on before, you need people to peel back their emotions. You go to an auction, egos come into play. It's very emotional. It's extremely stressful. And next thing you know, you spent 40 grand too much.
And that's why I hate to give both ourselves a plug here, but it's true. That's why good advice through this process is so crucial. Sometimes people use a friend that's a lawyer, a relative that's a lawyer, to give them advice on the contract of sale and the purchasing process. And if that person is not up to date with current market terms, expectations, bank processes, valuers processes, they could lead the person astray. So that's why it's crucial to engage the experts and the appropriate advisors.
Yep.
So the step one is solicitors, and obviously step two as well as the mortgage broker or mortgage provider, and listen to their advice.
Yeah, 100%. And as you said, it's also about finding the right advice. Conveyancing is in this relatively weird space, especially from a practitioner level, where everyone's racing to the bottom to provide the cheapest price possible.
Yeah.
Cheapest price possible, and they just want to churn out volume.
A no frills offer.
No frills offer. Get 3 contract reviews for free. The economics of it just don't work, right? Especially not when you want to provide a detailed and accessible service.
Yeah. Let's also call out something there. Big difference between conveyancing and a soliciting or solicitor's firm. Do you want to elaborate the difference of the two?
Yeah. So look, you've got your conveyancers that will do conveyancing. They can do conveyancing, but then that's all they do, right? And it's
they can't give advice.
And to some extent, it's a lot more of a tick and flick exercise.
Yeah.
Right. In the event that an issue does occur, and sometimes things go wrong, or like I said, there could be a dramatic change in the condition of the property from the time of signing to the time of settlement. I had one probably just shy of a year ago. It was a 25-acre property purchase out in the Hawkesbury, and it was an extended settlement. And during the time period of exchange and settlement, the vendor just dumped copious amounts of asbestos. Truckloads of asbestos, created a mini island as if it wasn't going to be noticeable, right? I'd never seen anything like it. It was mind-blowing. And a conveyancer then would not be able to handle that situation. They wouldn't be able to litigate and really be able to give the detailed advice that a purchaser, we're acting for a purchaser in that capacity, as to what the next steps of the process might look like from a court action point of view. So it's all good and well sometimes to go for the cheapest option, and funds might be tight, but for the sake of what might be a few $100, will save you a really expensive exercise come down the track, because when it goes wrong, it goes wrong.
Yeah, it's good advice. So let's sort of, I guess, move on from those common legal issues. I guess key clauses buyers should actually understand. We sort of touched on that, but should we elaborate on any other points in there?
Yep. So I'd say right off the bat, probably the most common request that's made and otherwise accepted is for a 5% deposit to be payable.
Yeah.
Right, for a contract. What a lot of people maybe don't appreciate is just because the vendor is willing to accept a 5% deposit doesn't mean that that's where it ends. It's still technically, and it will usually say on the front page of the contract, the dollar amount for the 10% figure, and that is technically what you're liable for. So yes, the vendor is willing to accept 5% today at the time of exchange. Technically, you pay the remaining 5% on the day of settlement, as well as the remaining 90% of the purchase price.
So to give a bit more color there, and yeah, I agree with you, that's something that's common for both vendors and buyers to misunderstand. You're not, so as the vendor, you're not taking any less of a guarantee at 5% versus 10.
No.
You can just, even though there's only 5% in the trust account, if for some reason the purchaser can't complete, you can still
enforce your rights against them to go and, you've got to
pursue the 10% deposit plus costs.
Yeah, plus costs. That's right.
Plus damages.
That's right.
And same way on the buyer, that you should actually have some sort of negotiating power by saying the 5% is sufficient, right?
Yep.
Like, because I'm still on the hook for the 10.
Yep.
We just make it work with the 5%.
Yep, that's right. And then if you want that actual coverage, and we can get it across the line, is if you are proposing for a 5% deposit to be payable, then generally to give you yourself that protection as the representing the buyer, is make sure on the front page of the contract it only has the 5% figure, and then it stops there.
Great advice. So early deposit release clauses, that's another one that we see here and there, and I guess it's a little bit ambiguous on, some people feel on, is if there's risks associated with the vendor or the buyer.
Yep, 100%. So, it is relatively a risky concept, right? So, you're a buyer, you're, potentially agreeing to release a deposit. Now, there's effectively two forms. Is it going to be a unilateral release? Theo, I'm giving you my 5%. Go and spend it however you will, right? I know when I prepare my contracts for vendors, I ask for it to be a unilateral release. We're taking our deposit. We're going to spend it however we want, right? For a vendor, that's fantastic. For a purchaser, it's a nightmare, right? Because one,
the vendor might not complete.
Well, the vendor might not complete, right? And difficult to do, but is technically possible, right? So vendor might not complete because maybe now you've released that deposit to them unilaterally. They've gone and maybe spent it, whatever, at the racetrack.
And
right?
Sometimes there's an issue that you don't know about as the buyer, preventing the vendor from being able to release the property.
Yeah. Well,
for the purchaser to take over security, they can't release, let's say, a mortgage over the title.
That's right. Maybe they needed or 90% to pay out their loan. They've got a second mortgage or something. You've gone and released 5 or 10%. They've spent it. Now the remaining balance of the sale is not enough to actually pay out CBA.
Yeah. And so you would not know this as the buyer. Very rare, but obviously where that would be of concern is someone in hardships.
Yeah.
So if there's any red flags of that, if sometimes the agent hasn't done their job correctly and told you that, that's a situation where you don't want to release the
funds. So, and then otherwise we would recommend that if that is something that you are considering, it's one, we want to see at least a bank statement from them showing us what their remaining balance on their mortgage is, right? To get some comfort that there is equity in the property. Or otherwise, we agree to release a deposit only for the purposes of allowing them to purchase another property or pay stamp duty, right? So at least that way we know that the money's been spent on another real asset that we can otherwise recover from.
Yeah.
And ultimately, we would just like that money to then be paid into that agent's trust account, to support them in their purchase, but it otherwise can't be released from that agent's trust account unless we've given written authority to do so.
So there's line of sight of the funds.
Always.
Yeah. Yep. Yeah, that's good advice. Finance clauses. So it's not as common in
New South Wales.
But Queensland's common, Victoria common?
Common Victoria, common WA, common in Queensland, as you said, right?
Yep.
Very much common in all of those jurisdictions.
We're essentially allowed, just to elaborate what that means, you're allowed to go out and get formal finance. You can make an offer basically subject to formal finance.
Correct.
Which I can believe from transactions that we're privy to in Victoria, that a lot of the time people are purchasing a property without the finance in place. Now, when I say without the finance in place, I mean without even a conditional approval in place.
Yeah. Oh, it's a bit of a Wild West scenario. They'll just go and, I don't know, do their own research and analysis and I think this property's worth $1 million. I'm just going to go and sign a contract offering $1 million.
And then I'll go figure out the finance later.
I'll go 21 days or 14 days. I'll just go figure out the finance later. That's right.
And isn't that just a clear example of just behaviors and expectations that become the norm and accepted in a marketplace, right?
Yeah.
So those buyers just now know that legally what's expected in these commercial or legal negotiations is a period to go sort out your finance.
Yeah.
And worst case, if they don't sort it out, they lose what, 0.25%.
Yeah, some of them vary across the different jurisdictions. Sometimes you might even just pre-negotiate a figure. You just might say, well, whatever, if we can't find finance, we'll forfeit $2,000 or we might forfeit $5,000. It varies jurisdiction to jurisdiction. But so
what about
it is definitely an interesting concept, but probably also another important thing to do and to make the audience aware of is, what are the conditions attached to those finance conditions? So you might say you've been given a 21-day period, but then the onus is on you as the buyer to either say, yes, I have achieved finance approval, or no, I haven't. And then you've also got to be concerned, or you've otherwise have to concern yourself with the wording about whether or not it could be deemed satisfied. So let's say you just forget to notify the other side.
Then it's an assumption.
And it's been deemed as if you satisfied that condition, but you might actually not have the approval.
Yeah.
Now all of a sudden it's too late.
Yeah, I've seen some of that actually in commercial sort of contracts or like options.
Yeah.
Once the option lapses, they can sometimes try and say, well, you're deemed to be proceeding unconditionally now.
Yeah. It's just a self-executing clause.
Yeah.
So, things that people might think are benign, again, it's really important to get that correct advice early on so you can be aware as to what your obligations are in a scenario that, you are sort of operating in a bit of a Wild West scenario.
Mindful of time. So another couple of call outs here. Changes to the standard clause 7.11, which is all about the ability to raise a claim.
Yep.
Some call outs there.
Yeah, so that's another one of the gotchas in the standards.
Mm-hmm.
So it'd be a very benign amendment in the special conditions whereby standard contract provides for a 5% threshold for you to make a claim. So if there's an issue with the property, you can raise a claim with the vendor to maybe rectify that issue. If the dollar value associated with that issue is greater than 5%, the vendor can then elect to say whether or not they do or don't want to deal with it. If they don't want to deal with it, they just say, Theo, here's your deposit back. We each go our own way, right? What you'll find is it's probably a 50-50 scenario is in the special conditions, I'll either change that 5% threshold to either 1%, which is usually your most common negotiated final point, or they change it to $1. Which then basically means if you raise an issue whatsoever, it's going to be worth more than $1. The vendor can just say, Theo, not dealing with it. Again, puts you back in that scenario of take it or leave it.
Yeah.
Either I'm not fixing it, here's your deposit back, and you got to start your search all over again.
What about default clauses for penalty interest?
Yep. So again, just trying to negotiate those interest rates down. So it's not uncommon to see default penalty interest clauses to be like 10, 12, 15%.
Yeah,
right?
I thought that's normally the standard, about 10 to 12.
Yeah, to some extent, right? We always negotiate them down to at least 8. And I'd almost find that you'd find 8 get agreed 90% of the time.
But pretty aggressive to see like 15, 20.
It is aggressive, but that's the protection you otherwise, need to afford your purchaser. Or sometimes it might not be the interest rate. It would be, one, how much is the vendor solicitor charging you to issue a notice to complete? Might be $400, might be $500 plus GST. Sometimes they also put in maybe an extra charge of $200 just to reschedule the settlement because maybe you've missed a time slot on that day at 1 o'clock and it's going to reschedule at 3. So now they've charged you $200. And then it might miss again at 3 and it might go at 4. So they're going to charge you another $200 when really there's maybe 5 minutes worth of work to accommodate that change. It's ridiculous.
Yeah.
But these are all products of practitioners trying to claw back fees because they've all raced to the bottom on with respect to their own professional fee. So now it's all about gotchas with respect to the poor buyer, effectively.
All right, well, moving on. This one we want to touch on because people would assume it's quite relevant to a discussion with our legal partner, but it's probably somewhat more relevant for a discussion with your accountant and also the mortgage broker, and that's the way you structure your purchase. So in your individual name, in a company or a trust, and aligning a legal strategy accordingly. So what's been very common in recent years is people purchasing properties in trusts to negate servicing requirements.
Yep.
So a lot of the time, lenders will exclude the loan that you have within a trust if you provide a letter simply suggesting that the trust can meet its obligations and commitments.
Yeah, correct.
And therefore, you do not need to provide financials for the trust. That accountant's letter saying that trust is meeting its commitments and liabilities is good enough to extinguish that concern or that liability within the trust.
Yep, that's correct.
So what people were doing, essentially, if you had $1 million borrowing capacity, you could replicate that multiple times and buy multiple properties. APRA, I think, taps certain lenders on the shoulder about that one and said, listen, this is a bit of a loophole in servicing. Macquarie Bank, for example, was a bank that offered that. And at one point, July last year, there was circa 40%, I believe it was, of all new loans nationwide were done through Macquarie. So now they've pulled back on that. And they said you can't use that as a servicing loophole. It was also had a different intention. That was the intention behind excluding debts in trusts and entities for servicing was more about business debts, you know, like liabilities associated with your business. Not property debt for investment purposes. I guess then, you know, that aside, if you're taking away legal, servicing strategies and optimizing borrowing capacities, what's the legal considerations in those various structures?
So obviously, if you're just purchasing in your individual name, it's the most simplistic. It's your own servicing. It's your own debt. And it's your own asset, right? So, yes, you know, you might find some security exposure, you know, in the event of, I don't know, maybe you go bankrupt and obviously your own personal assets are up for grabs, right? Or if you get involved in some other type of legal matter and there's a large judgment made against you and you can't satisfy that judgment, well then, you know, they could go down the route of getting a writ over your property and looking to, you know, force a sale of that property in order to recover that debt. Whereas if you're purchasing in the company structure, then at least that is now owned by a separate legal entity. It's the company is one in of itself, and then that might otherwise provide you with the majority of the protection that you otherwise need. You'll also get the benefit of, you know, company tax rate as well for the purposes of tax, and then you do also have the luxury of potentially using, you know, a trust or a trust structure, right? Again, that is also to provide security, you know, asset protection security to make sure that, you know, if something was to go wrong with you personally, then you know that whatever that issue is can't bleed over and otherwise contaminate and expose that property that's otherwise been purchased in that trust, right? Or vice versa, something could go wrong with the trust asset and it's not going to come back to your family home also, right?
They're the big ones. They're the common ones, right?
Yeah, that's right.
The reason I allude to maybe speaking to an accountant is because there are other considerations.
Massive tax considerations.
Yeah, massive tax considerations, which should probably be the first point before sort of deciding what structure is appropriate. You know, just to call out some of those tax considerations. If you buy something in a company, it doesn't get the capital gains tax discount.
Correct.
A trust does and an individual does, but not a company. A corporate trustee is different to that because a corporate trustee is holding an asset on behalf of the trust. So a corporate trustee, whilst it's still a PTY LTD company, it does get the 50% discount. And for people that don't really understand that whole capital gains tax discount, in a nutshell, you basically pay twice the amount of tax if you don't have that discount.
That's right.
So companies don't get that. Sometimes if you buy investments in a trust, if you're a self-employed individual, there are ways to get money into that entity to purchase the investment property, let's say, which would be tax advantageous. So you could pull profits out of your business and do intercompany loans and only pay company tax rates on that. So you don't have to pay the full marginal tax rate. Therefore, you can accumulate a deposit for an investment property in a tax-effective manner. So all that, we're not accountants. We've got a lawyer here. So speak to your accountant about that. That's just general advice. I guess moving on, we sort of already touched on negotiating tips for cooling off periods. Any other call outs there?
I would then say, again, you know, usually in a hot market or even also seeing a reciprocal scenario in a cooler market where effectively trying to purchase a property is, for most buyers, it's mental warfare with the real estate agent, right? Real estate agents are experts at becoming your friend, giving you the illusion that they're your friend, giving you the illusion that they're going to help you get into this property, right? It's quite often that you have to remind people that they don't work for you. They work for the vendor. Their job is to get you to spend the most amount of money, right? And sometimes as part of that process, you could potentially have concerns that your offers are maybe not being presented to the vendor, or maybe not given the right type of presentation to the vendors. And so sometimes, particularly, again, even with first home buyers, or particularly in wealthier suburbs where prices can really fluctuate a lot as well, is to just present offers on signed contracts.
So that's a really good call out and great advice. And another thing that we were touching on this morning in our team meeting, Justin was presenting to the team and sort of suggested this advice, and something that we see quite often. I hate to say it, is that agents might present offers for their own selfish reasons and sort of withhold offers from vendors, which might be the highest offer, because another potential buyer has promised a listing.
Correct.
So, letting the solicitor present your offer in the form of a signed contract is usually the best approach.
That's right.
Communicate with the agent, still keep them involved, but then simultaneously get the solicitor to send that signed contract.
And sometimes it's just a product of what your affordability is. If you're a first home buyer and you might be like, look, I can only afford $800,000 for this apartment. Well, if you know that that's your number, let's just chuck that number on a contract, provided that you're satisfied with its terms. Or we can even be super aggressive and even amend the terms on the contract as well. Cross out a certain clause, and then just send it, lob it across to the vendor solicitor, and say, hey, here's our client's offer at $800,000. They've deleted these clauses that they didn't like. Please present that to the vendor for consideration. And then that because you've given it to the vendor solicitor, they have to go and seek instructions. There can't be any withholding and making sure that your offer is not otherwise going to get presented. You can, and you would, CC in the agent in on the email so they're aware, and they can try and get in front of it and make a phone call if need be. But sometimes it's the best way to get things done. It could also be the case in a eastern suburbs style transaction. It can get very hot, and quite common tactic for real estate agents is to make you almost go into a silent bidding auction. They'll ring you, they'll ring the lady down the street. Hey,
a bit of a Dutch auction.
Right? Sometimes you don't even know if there is even anyone else participating, right?
Sometimes it's a great tactic for the agent.
So, you might be of the opinion that, look, me and my wife are comfortable and we're happy to offer $5 million for this house. Let's just send an offer of $5 million. Give them a contract to sign, and whether or not there are other participants, we'll find out pretty soon, because the lawyer will come back and say, hey, it's either been rejected, or they'll come back saying, look, we can appreciate your $5 million offer. Thank you. If you can make it 5.1, we've got a deal. And because you're also giving the vendor a lot less to consider. You become a known entity. You can also be aggressive and go and pay the 0.25% or the 5% into the agent's trust account. It's safe anyway. If the deal doesn't get done, they refund it.
And then the vendor and the agent could be, all right, this is a done deal if we just accept it.
Yeah, that's right.
Yeah, everybody wants. It's a stressful process for everybody, right? A lot of people think it's just stressful for the buyer. The vendor is equally as stressed about one of their, if not their most valuable asset they're trying to consider selling.
So we've had open homes for the past 3 weeks. We're getting offers. We're getting close to the number, but here comes some guy, presented a signed contract, paid the 5% deposit into the agent's trust account. He might be 20 grand or 15 grand below asking, but do I really want to, evacuate my family from their home again this weekend, make sure it's all nice and clean, maybe get that extra 15 grand, or do we just accept it and it's done? And most often not, they just accept it and it's a done deal.
So moving on, once again, mindful of time, 2 more things that I wanted to cover today. And if we don't cover something in enough detail, that is a great reason to reach out to Justin or his team at LAS Lawyers. This next one's going to be something that we won't cover in enough detail, which is off the plan risks and legal considerations. Now, what we mean by that is purchasing a unit off the plan. The contracts of sale for an off the plan purchase,
400 or 500 pages long.
Yeah, big difference between a standard contract, and that's because there's all types of things in there. There's there's an allowance for the vendor, being the developer, to vary the size of the square meterage, I should say, of your unit. So you might be buying a unit that's 100 square meters. Do you think that was the deal?
Yep.
But there's a clause in the contract that says, well, we can vary that. I've seen up to like 20, 25% variance.
Yeah. Oh, it's absurd.
So you can get a unit on completion that's 80 squares. It's like, well, tough luck.
Yeah, I've just lost 2 bedrooms.
Now,
you know?
Yeah.
You know what I mean?
So a lot of the time, people don't understand these are negotiable clauses.
Yep.
So you can negotiate and say, no, 20% is a bit ridiculous. Let's make that more like 10%. And there are reasons for these clauses because there are unknowns for the developer throughout the construction period, or a process, I should say. So, like, we've got to support developers at the same time getting product out of the ground. But there's a way to manage what's reasonable from the purchaser's end.
Scale it back to 5% at the max.
Yeah.
Right. That's where you want to be.
Other things to consider for an off-the-plan purchase contract.
Obviously, the time frame of the sunset period, right? Is this a 2-year deal? Am I going to be in this boat for 4 years or 5 years?
So you're speaking like everybody understands what the hell a sunset clause is.
Yep.
Let's assume no one knows what that is.
Okay, so assuming that you don't know what a sunset clause is that's the time frame for the developer to actually deliver you the product.
Complete.
Right? To complete the construction.
It's a grace period for delays, basically.
Yeah, well, it's the time period for the developer to build this building and deliver you the product, right?
Yeah.
So, you could be buying off the plan right at inception, and it might be a 3-year construction. So ordinarily, you'd probably have a 3.5-year or 4-year sunset period. So,
meaning that the build can have an extra 6 to 12 months delay.
Yep. But then you also need to be mindful of potential further extension clauses to allow the developer to even further extend the sunset period.
Yeah.
Right. So you might have an initial 3-year sunset period, but then they might have, we can delay by a further 6 months for these reasons, and maybe a further 6 months on top of that for these reasons.
So there's clauses within the clauses to extend,
That's right.
things like the sunset date.
Yep.
And hence why that off the plan contract is so thick and detailed.
Yep, for sure.
It's something that definitely needs appropriate advice, but something that it's obviously worth considering. I've seen some great wins in off the plan purchases. I know there's been a bit of negative sort of sentiment toward them in the past because there are a lot of developers that are probably overpricing and doing the wrong things. The regulators have done a great job of removing things, let's say bad practices that developers used to get away with in the past. So one practice that used to happen a long time ago was the ability to revoke the contract if there was an increase in value significantly above the agreed purchase price.
Well, that again came down to the sunset clause, right?
Yeah.
So they would build a really long sunset clause, and if property values go crazy, maybe over a 5-year period, then the developer would just do the build slow on purpose to make sure that period expires,
and then they can revoke the contracts and sell the units for more.
Yep. Thank God that regime's sort of been changed now. And if the developer wants to do that, they do have to go to the Supreme Court and get orders to justify why they should be allowed to terminate the contract.
Yep.
But definitely something to be mindful of. Another big one is making sure that the schedule of finishes correctly captures what you think you're buying.
Oh yeah, there can be big variance there.
Big variances there. It's just like going to a home world when you're looking at building a property, right? And you walk in there and there's probably $300,000 worth of extras, higher ceilings, nicer tiles that aren't actually included in the package that you're going to buy. No different to a display suite for an apartment. Mm-hmm. You need to make sure that what you think you're going to end up with as your final product is captured.
Yeah. And sometimes that's just a miscommunication along the way, right?
Yep.
It's not deliberate. It's not strategic. It's not, the developer being cunning. It's sometimes they didn't get the modified spec that you actually wanted, marble instead of the Caesar stone in your kitchen. There's sometimes they don't get the instructions that they should have received.
Yep.
And
common ones probably like zip taps.
Zip taps, yeah.
Super expensive, but whether or not they are included was in the display suite, not in my house because it wasn't in the schedule of finishes.
Yeah. So lots to look out for, and that's, like I said, one of the subjects that we're not going to be able to cover all the things to look out for.
That's an episode in on itself.
Yeah, that's an episode in on itself. I guess to finish off on that one, lending is also something that you really need to consider with off-the-plan purchases. What I mean by lending, bank policy banks' policies have very specific clauses or policies toward off-plan units. So some banks have a max LVR for brand new stock. They also naturally can be quite conservative in their valuations. So make sure that you tell your broker or bank that you are looking at a brand new unit, that's for sure. Last but not least, legal considerations with SMSF property purchases. So in recent years, when I say recent years, the last 5 years plus, we've seen a huge surge in people using their superannuation to set up an SMSF and buy a property with their SMSF. Combination of reasons behind that, lack of performance in traditional super funds, people being more confident about
Australian property market.
Australian property market and purchasing investment properties.
Yep.
There's also a plethora of buyers agents out there that are spruiking, let's get that super into a 80% geared investment property. And there's a lot of them have got a lot of merit to what they're saying. So with that, there's a lot to consider. What are some of your call outs there, Justin?
Not so prevalent in New South Wales because New South Wales contracts are generally, they're prepared by solicitors, right, or conveyancers. So you'll find that the actual purchasing entity and the description of that has been recorded correctly, right? And what I mean by that is when you are purchasing using a self-managed super fund and you're borrowing money, the self-managed super fund itself is not allowed to borrow money to purchase an asset, right? You have to set up a bare trust, right? Got to set up your bare trust, have your trustee in place, and that all needs to predate the contract. You need to have that structure set up, and you need that structure to be correct, and most importantly, you need to be correctly reflected on the contract, right? What you'll find in the other jurisdictions, such as like Queensland or WA, where the contracts are prepared by the real estate agents, is then the purchasing entity's details are not recorded correctly. It just might say, Theo Chambers Family Trust, but that can't buy an asset. It's prevented by law, and that's not even a true description, not even a true legal description, right? So now all of a sudden, again, because things are potentially done subject to finance, they've just gone on a weekend, seen a house, said, "Yep, I'm buying this in my self-managed super fund. I'm the Theo Chambers Family Trust," and the agent's gone and recorded in the contract and exchanged contracts, and they might have come to you and me after the fact. Now all of a sudden I've got a contract here where the purchaser has purchased incorrectly. Now how do we go about trying to unwind that transaction and correct the mistake?
Yeah, that's not uncommon. I've seen that quite a few times.
Happens all the time.
I guess another big legal consideration that some people don't fully understand or appreciate, once again tying back into lending policies, is that the super fund liability, the debt on the mortgage, is not personally guaranteed by the individual. So it's a non-recourse loan. It doesn't go on your balance sheet. So you might have been tapped out for servicing in your personal name, but you can still buy a property in your super. And then when you do buy that investment property in your super, the debt on that property, you never have to factor in your future servicing in your personal name.
Yeah, look, it varies, right? I would say that's generally the case, but then it's also not uncommon to find that, especially depending on the lender, right? Because usually the lenders in that space are not your usual big four, right?
Yeah.
They then will want a PG also, right? So, and they'll also expect a requirement that the purchaser will go and get independent legal advice and provide a certificate to that effect, right? So it's also making sure that, yes, while there are limited recourse borrowing arrangements, which is usually the norm, sometimes that might not be the case, and making sure that they are otherwise aware of that.
So I think you're talking about really complicated commercial borrowings. Typically in the residential space, they're not allowed to do that. And that they might look at your personal position from a servicing capacity point of view. So what I mean by that, if you historically haven't had enough contributions going into your super, they might say, hey, and if you're committing to making more contributions into your super in order to support the loan, they might look into your personal servicing and say, how realistic are these personal contributions that you're going to make that you haven't made in the past?
Other things to also consider when when operating in that realm is restrictions as to what you can actually use those borrowed funds for. So there are, and you would know better than most that there are strict requirements as to how that money can be spent. Usually can only be spent on acquiring the asset itself and potential repairs to those assets, but you can't go and borrow money in SMSF to then go and do a development on that asset.
Yeah, you can't use borrowed money in your super or you can't just develop full stop.
Yeah.
There are tricky ways that people sometimes get around it, where they employ another entity that they own that's not the superannuation entity that does the development.
Yeah, there's magicians out there.
Yeah, there's magicians out there that do the completed product, but rule of thumb, development is not allowed in your SMSF.
Correct.
That's the rule that you should assume as following.
Yes, 100%.
All right. Well, Justin, I think that's it for today. We've called out a lot on things to consider. There's some great insights there that I'm sure we could share with our clients and some summarized key highlights and reels on socials and whatnot. Of course, as always, if you want to speak to Justin and his team, if you've got any more questions, you want to speak to a mortgage broker about some of these sort of considerations, there's wherever you listen to your podcast, on Apple or Spotify or whatnot, there will be a link to our website. Hop on there and inquire now, and we will happily put you in touch. Apart from that, Justin, thank you so much for coming on board.
Mate, thank you for having me. Really appreciate it.
And thank you once again to all our listeners today. Make sure you like and subscribe to wherever you listen to your podcasts. This business is built on word of mouth, so please refer us to all your friends and family. They just want to say tune to the latest property and finance tips. Thanks again. Please note that this information is of general nature only and has been prepared without taking into account your particular financial needs, circumstances, and objectives. While every effort has been made to ensure the accuracy of the information, it is not guaranteed. You should obtain professional advice before acting on any information shared in this podcast.